Discussion. Financing the transition to renewable energy, overcoming challenges through practical solutions. Inviting on stage our esteemed panelists for this round, Mr. S.K. Bo Resenberg, Consul General, Head of Trade and Innovation, Consulate General of Denmark. Mr. Priyank Kuchal, Director of Global Banking, HSBC Asia Pacific, and Sector Lead for Energy Transition, HSBC. Mr. Shyam Sharma, Chief Financial Officer of O2 Power. Mr. Pratyush Thakur, Investment Director and Country Head, India Blue Leaf Energy. And calling Sandy Khera, our Treasurer and CEO, Enel Green Power. He is the moderator of the session.
Today, we've heard about the massive opportunity that lies before us in renewable energy in Karnataka and across India as we look at scaling up to meet the ambitious targets of 500 gigawatts by 2030 and, of course, achieving net zero by 2070. We have made significant strides and remarkable progress in terms of development of renewable energy in the past decade. We are close to clocking 50 gigawatt milestone in wind installations very soon, and the 100 gigawatt mark in solar also. Overall, we are close to 200 gigawatts, which means there's still a long runway to be covered. And this energy transition requires massive capital investment. In Karnataka, we're talking about 20 gigawatts of wind capacity coming in, which in itself is about close to 17 or 18 billion dollars of investment. And when you look at the overall plans for investment in the country, this number looks at, according to some estimates, at about $300 billion. Now, when you're looking at mobilizing this scale of financing, India has to tap into a diverse range of funding sources, international and domestic, both in debt and equity. Now, also specifically scaling up wind projects, whether it's plain vanilla wind or wind hybrid solar storage projects, these call for reduction in cost of capital, mitigating risks, increasing the bankability of PPAs, easing the investor entry and exit through asset sales or mergers and acquisitions, looking at innovative tools of financing, also looking at reforms we talked about in the morning in terms of land acquisition reforms or guidelines, and having a stable regulatory and policy framework, all these to attract cost of capital at competitive rates. As we say, money makes the world go around. We're not sure about that, but money definitely makes our wind turbines go around. So to dwell on this important topic of arranging financing and handling issues around challenges of financing for this energy transition and looking at the opportunities before us, we have an eminent set of panelists here along with me on the dais who will talk about this and also share some international experiences and experiences on the ground in India. So without further ado, I welcome everybody again on stage and thank you so much for joining us. Starting with you, SK. While Denmark doesn't have very direct CO2 emissions which are high, it's rather small, But having said that, Denmark has been a pioneer in leading green initiatives, and in many ways has successfully transformed its entire energy system from black to green while ensuring economic growth. And this has a lot of parallels with where we are in India. We're at the cusp of not only an energy transition, but an economic transformation as we're looking at double-digit growth for decades, right? So what has been the secret sauce for success for Denmark of not only kind of financing green initiatives successfully, but also becoming a financial hub for green financing around the world?
Yeah, thank you very much, first of all, for the invitation to participate in this important event. I think basically one of the answers to the question is that there's been a lot of these events in Denmark and also in India, and that's what leads to the continuous development of a green transition and sector. So congratulations and thank you to VIBA for inviting Denmark into this session. In short, the story is basically what we are witnessing in India today. It starts with political ambitions and will, stability, then it requires a fast-moving and ambitious private sector. Then it requires a nice tango between the two for a period of time, and constant tango because the music theme basically changes from year to year or crisis to crisis. And then at the end of the day, it also requires that the citizens and the population basically moves from a tango to a trio and becomes part of both the solution when it comes to the off-taker, but also when it becomes part of the financing part. So Denmark, it all started with a crisis in the 70s. We were 100% dependent on fossil fuels, I'm pretty sure most people know. And we didn't have hydro, we didn't have nuclear, but we had quite a bit of wind. And basically that was the beginning of the green transition from black to green in Denmark, right? The political ambition, the political will, a strong R&D community, a government-owned, very black energy company, today known as Ørsted, who basically were one of the first and big conglomerates in Denmark that took, from an industry perspective, the decision to turn green, had the capital and the experience to do so. And then from there came all the other companies that wanted to be a part of this journey and spun out from that. And some of them are here in this room and had different types of green financing frameworks as a strategy to basically become part of the green transition. So long story short, I think what we are witnessing in India today and why we are so happy to be a very strong partner with India is basically the same journey that Denmark has been on and is still on. And I think one important point here is that the journey will never end and there will be obstacles along the way, and that's why these events are super important to highlight them and remind each other about them. The last offshore center in Denmark, just before Christmas, was a huge failure. No bidders at all. And we run around and we tell people that we know how to do this, and we are the best in the world, but the latest offshore tender in Denmark had no bidders. And then what you need to do then, you need to have another series of meetings like this with politicians, regulators, and developers to figure out what's wrong. Well, 2025 is not the same as 2020, so maybe we need to look at how those different financing models, public-private partnerships work on a frequent and continuous and agile way. So that's one of the learnings, that's accepting failure and then talking with each other about what is it that we need to tweak. And maybe it's definitely not one size fits all, and it's definitely not something that we can just fix and then do the same thing next year and next year and next year again.
Thank you, very interesting, and I like the musical analogy that you gave. So rightly, you need all players in the orchestra to play a beautiful symphony. So everybody needs to get together, and I'm glad that you share that events like this help all of us bring together all the players in the ecosystem to understand and appreciate each other's concerns and dwell on issues. So, Priyank, coming to you next. We heard about through the day the opportunities in Karnataka and how Karnataka has been at the forefront of leading this mission on green energy. Of course, this energy transition is a mission for the entire country as well, and um, as, um, as a banker, you know this requires a lot of capital investment and commitment. So from your standpoint, what is the size and scale of the opportunity in terms of financing that you foresee? Also, given that the energy transition requires huge commitments, what are the traditional and innovative tools of financing that are currently being utilized or are needed to help drive this change and attract capital?
At the outset, thank you, Vipa and Sandy, for giving me this opportunity. You're right, absolutely. The size of ambitious targets that we have in terms of 500 gigawatts by 2030. For the next 300 gigawatts from where we are, it requires more than $200 billion of funding. And this size of funding will never be achievable just with the traditional sources of funding that we've been deploying. And it is always an art of learning from what we are seeing the best practices across the world. So not only the plain vanilla project financing, which has been there, what we also look at solutioning is mini-perm solutions, which give, the appetite of, which increase the appetite of foreign lenders to be able to lend given the asset liability mismatches. What we've also seen innovatively being done is we were leading a funding of close to $4 billion for a 1 gigawatt offshore financing in Taiwan, which involved participation of more than 7 ECS, 5 European, 2 Japanese as well. Now, those are pools of capitals, deep pockets, which are yet to be tapped in India, but they are a very important source of long-term stable financing being made available. Then also comes the important role of DFIs. Now, you've seen in one of your projects 4 DFIs, actively participating, but we will see more and more DFIs coming in and playing a very important role in these overall scheme of things. And also, what we've seen evolving, and we expect in 5 years down the line, this will be a significant contributor to the capital requirements, is the bond market. We've seen close to $4 billion of sustainable bonds being raised in India last year. We expect this to exponentially grow and be a significant contributor to be in the overall scheme of things.
Thank you so much, Priyank. And it's heartening to note that bankers are open to providing innovative financing structures to suit the project requirements. Now, from innovative financing structures to innovative project structures, I'd request Pratyush to come in at this point. We are seeing a shift also in the kind of projects that are being structured in terms of moving away from traditional long-term PPA-based projects to projects which are being built or developed to cater to the open market or the merchant market sales, right? And we understand that Blueleaf is recently deploying a project for purely merchant sales. Congratulations on that, and would also want to understand from you how you structured the project, and also importantly, how you propose to finance that project going forward.
Yeah, thanks, Andy, for giving the marketing opportunity. Thanks, Vipa, for inviting me. But yeah, this is a project which is 300 megawatt in total size with almost equal wind and solar component, located at the same pooling substation in Madhya Pradesh. We as Blueleaf, when we started, of course, we were invested in Vibrant, which is a corporate PPA player, and we were looking at the utility offtake market. And we realized that, unfortunately, in our sector, and maybe a controversial statement, the upside is limited if you sign a PPA, right? Because you sign up to a nominal, non-inflation-linked PPA, which is unique to India, and in many other markets, there is an inflation protection provided. But to international investors, it is quite a risky proposition to get into very long-term PPA, and also at the rates we get into discovered in the auctions. So we were not very comfortable with the prices discovered in the auctions, and we thought that we need to change our strategy in terms of the revenue realization for the project. But at the same time, investing into power market risk, either for equity or debt, is extremely difficult, because we don't have a power market where you have a forward market and you can take a long-term view on what kind of prices can be realized on a long term. We've got a very solid spot market, but that just gives you a day or a couple of weeks at max. But what has happened over the last few years, or maybe last decade or so, that our spot market has become relatively deep. I'm saying relative, one can take a view not that deep, but there is at least, say, 100 terawatt hours of production being traded over a year. And one can take a view that the models will give some sort of prediction on what kind of revenue realization you may have. And we started off with that, but we needed someone to anchor at least a baseline revenue for us. And for that, thankfully, at least large international companies in the world right now are committing to their voluntary targets of renewables. They want to get to 50%, 100% renewables by 2030. And one of such large tech company agreed to buy environmental attributes in terms of I-RECs for a 15-year period. So we got a long-term baseline revenue, which was coming from the sale of environmental attributes. And then we had to sell the power, which you could call brown power or power without attributes. And unfortunately for a renewable energy generation profile, the only way we can sell that power is exchange. Because otherwise, if you participate in the bids, you're competing with thermal, and you can't guarantee that kind of load profile. So the next challenge for us was to get a merchant exposure to get finance, both from equity and debt. Macquarie is 100% investor in our company, and they also have a lot of experience, even in the Australian market, where you don't get long-term PPAs. But we did appoint several agencies to provide us models on what kind of revenue realization we may have. And there was at least one point in time where we had two lenders who would support a view on the power markets. So they would take a more conservative revenue profile and would be able to finance the project to a, say, 70% kind of leverage. But at the same time, with that leverage and with this profile, our investors were not very comfortable. Because ultimately, equity is the first line of defense. If something wrong happens, the equity loses money first. Lenders have protection in terms of security, et cetera. So what we did was that we connected with power traders in the country. And one of the power traders agreed to write a PPA, which is again a 15-year PPA, where they're writing a floor price. If the prices fall below that floor price, then they will give us the difference. And if the prices are above that floor price, in that case, we'll share the benefits. So that gives an incentive for them to underwrite, and also gives us the opportunity to make use of any positive movement of the power prices. So ultimately, the way we structured it was that we have an environmental attributes contract at a fixed price for a 15-year period. We've got a power trader contract with a floor price, and that gives banks at least a floor protection that in the worst case, a minimum revenue would be realized. And then there were a couple of banks who also took a view that based on the market situation, you could also realize slightly higher than the floor price, and that was the underwriting case by the banks. So it is higher than the floor price, and we were able to secure 75% funding. And that showed us to our investors that there was commensurate return to the risks. And we were able to financially close this project. I think we've announced publicly. So Axis Bank was the lead lender. They've already downsold to 4 other banks. So this product and the project has been very well received by the financing community. Can I replicate it to multiple future projects? I don't know, because this is all lying on a power trader's ability to underwrite that risk. And unfortunately, our power trading industry is not as deep. They don't have as much capital to take a lot of risk. But I'm sure by looking at this deal and their experience in the next couple of years, there'll be more people coming out and financing such innovative structures.
Interesting. And again, congratulations on completing that project and also the financing for the project. Coming to Shyam next, Shyam, we've heard about all the issues faced by developers in executing projects, right? And you are in the front end or facing the bullets at the front line, because even before the issues start in project execution, uh, you have to raise financing for the project for your team. What are the key financing challenges that you've encountered or you think developers are facing currently for large-scale utility projects? And how can we mitigate risks on those projects?
Yeah. First of all, thanks, Vipa, for giving me an opportunity to delve more onto these topics. So coming back to the question what you have asked, Sandy, yes, the financing team's issue started once the PPA is signed, and within, say, 9 to 12 months, we have to do the financial closure. So the basic problem, and as the sizes of the projects are increasing, technologically, it is becoming complex, more of hybrid, RTC, FDREs, a lot of storage now. So access to this affordable financing is an issue at, because the number of lenders in this market is quite less. So if you take out all the PSU lenders like IREDA, REC, PFC, there are very few lenders in the market who will fund these kind of projects. I would say that some of the PSU banks do that, but they have limitation on the asset liability mismatches. So we ask for at least 20 years of lending, while their deposits is for 5 years. So they will always face those challenges. They have limitation on the leverage. They can't leverage more than 75%. If we go to the ECB side of it, there are challenges. You need to create a consortium of at least 4 to 6 banks to fund these projects. And given their credit appraisal process that takes a lot of time, sometimes it becomes difficult to get the financial closure within those timelines. So first is access to the affordable financing. I would say that the second major issue what we face is the delay in land acquisitions, which has been discussed in detail in earlier panel discussions. So particularly state like Karnataka has a lot of issues in terms of NA mortgages. It takes at least 2 years to do that. And we as a developer faces a lot of challenges with the lenders, and sometimes we face the penal interest as well. The third major issue is the lot of policy and regulatory changes when we bid, and by the time we start construction phase, there can be a lot of changes in terms of, I would say, change in law, change in taxation, change in overall DSM charges. So you can't count on that. ALMM issues. So we as a developer faces a lot of those challenges, and then we have to make the lender comfortable around it. So even if though we can claim it in change in law, but it takes time to get the CRC orders, and then that has to be taken up by the SERCs for approval. So we need a lot of maneuvering to get that CIL portion funded. The other major challenges what we face as a developer is the delayed payment from the DISCOMs. And other than the RIAs and state like Gujarat, other state getting us state PPA funding done is a challenge. So we have seen this in Maharashtra, Andhra, and other states, that all the developers have faced a lot of challenges. Even after the LPS scheme came in, which was a boon for the sector, still there are delays beyond the days mentioned in the PPAs. And I would say that the other major challenge is our capital market are not so deep. So we are very much dependent only on banks and financial institutions for the capital, what we require. So that is the major challenge. So might be because our long-term money like pension funds, insurance companies are not allowed, or very restrictive mandate they have in investing. So they can't invest in a paper less than AAA and all that stuff. So that restrict the long-term money to come in this market. And lastly, I would say that still yield co-structure or the InvITs are not the reality in this market as of now. So IPPs are still not willing to divest their assets into the InvIT kind of structure. So once that is done, might be that will solve a lot of long-term capital challenges.
Thank you, Shyam. Very insightful. Coming to SK, back to you again. See, we've seen that in the recent past, institutional investors, especially in the global north, hurt by recent financial market declines and inflation, are more concerned now with that geopolitical risks will add to market volatility. And because of this, they're becoming very risk averse, and allocation of capital even to climate funding initiatives, especially in developing markets like India, are getting thought through again or reduced. Now, in that context, how do you look at international investors assessing the investment opportunities in India or the risk profile in India? And as somebody who's promoting trade and investment in the country, how are you getting comfortable with the opportunity and the risks in the country?
I don't think it would be fair if I spoke on behalf of the entire international financing market. Maybe I should just try to focus a little bit on the Danish appetite, so to speak, from a financing perspective. Basically, I have never heard anything about the lack of capital. There's enough, at least in the Nordic region, and maybe that's because the pension funds are less restricted, but I think that's where the scale is coming from, at least when I look back to the Nordics and I look back to Denmark in terms of the deep pockets. That's basically my pockets and my fellow citizens' pockets, I guess, and getting those money out there working for green transition. The last 5 years, or 4 years, or 3, or whatever, the problem has been basically everything else than the access to capital. So higher costs on important materials, logistics, and as you mentioned, geopolitical movements. Let us put it that way, right? Focusing on India. Out of the 3 biggest Danish developers with deep pockets, only one has a huge appetite for India, a huge appetite. Is that because of India, or is that because of geopolitics around India, or is that because the fact that there are other places in the world where they are already exposed or more exposed, or where the flavor of whatever they can serve on the plate to some extent is suiting the asset owners better? I don't know, but I think 1 out of 3 is good. It could be better, but that one company in itself has a big appetite, despite, let's say, the fact that it is not an easy profile that India has seen from outside. It is complex. It's not one market, just like Europe is not one market. There are very different differences between the different states. Me and my colleague Suresh gets to understand some of them. We have mentioned land acquisition quite a few times today because we are in Karnataka and conversion. It would probably have been something else, some of the regulatory changes maybe, if we had been in Gujarat. And in that sense, you need to sort of spend a lot of time on each state depending on where you put your money and understand that and invest in it. So there is an appetite, but it's not something that caters to all from the Danish investment ecosystem. And whether that is because of India or whether that is because of somebody else offering something that fits that taste better, I think maybe that's more where I would put it in that bracket. It's also a global competition to attract the deep pockets, right? So how can we do that in an Indian context the best way possible? How can we make it, how can we de-risk and make it as transparent and long-term as possible. I think I mentioned in the beginning that it's an iterative process, and the regulation and the regulatory frameworks will need to change over time. But at the same time, you need that long-term vision and stability and transparency to make the investors, feel safe, even though that changes will come. So I don't know if it answered your question completely, but that was the best go I had at it.
Thank you, very useful. Coming to Priyank, as we've all seen, all project development has its own share of risks and challenges. In that context, as a banker who's expected to fund 70-75% of the project, what makes the RE sector attractive to you? And from a developer's perspective, what can project developers do to make projects more bankable when they bring these opportunities to you? Also, secondly, linked to that, we've been seeing that sustainability-linked financing or green financing is on the rise globally. And there is a specific pool of investors who are looking at investing this kind of capital. What can, again, responsible corporates and developers do in terms of better ESG strategies or more stringent disclosure strategies to attract this pool of capital as well?
Just before I answer, I think players like Shyam will not be very happy with 70-75%. They will be looking at 80% at least of the financing being done.
The more the merrier.
But, okay, so you touched very important aspects of it. To be honest, the key criteria for any institution from a lending perspective are the promoter track record, the strong experience management. They have the execution records of successfully, timely executing renewable projects, because all these renewable projects, each of them come with their own unique set of challenges. Some in terms of, say, land, some in terms of GIB issues, some in terms of maybe the PPA signing getting delayed, etc. So each of them comes with its own unique set of problems. So things which stand out and are extremely important from a lender's perspective are the track record of those promoters to step in case of a distress or in case of an issue, their ability to be able to support such projects. The creditworthiness of the off-takers is extremely important. Because ultimately the entire financial model is structured on the timely receipt of those payments. Land acquisition being under control, a strong financial technical plan, and ability to even access capital markets for the respective developers if they've already had a pool. Because I think Shyam rightly touched upon a point. We have a strong capital market, but I think the major limitation that we see right now is those capital market instruments are predominantly available for refinancing, are not available at the outset for executing greenfield projects, which is where funding is most critical for any IPP. I think coming to your second part of the questions in terms of disclosures, in terms of ESG standards, I think the key portions are, developing comprehensive ESG strategies is extremely important. Setting clear sustainability performance targets. The stronger disclosures is extremely important. So we've seen certain developers going for even external certifications. So we've done some of those certifications such as climate bond initiative certifications done by a third party. Those are kind of certifications which give a strong, immense comfort to lenders and the ability to lend. Also from a reporting standards, using recognized frameworks like GRI and SASB, brings along a set of comparability amongst developers, and transparency first and foremost is the most important aspect here.
Thank you so much. If I can ask Pratyush to come in at this stage. Pratyush, I asked SK about the perception of risk and the return expectations for institutional investors, global investors looking at the Indian market, right? I'll pose the same question to you. When you are pitching a project to your investment committee, to your investors globally, how are you gauging Is there a change in the expectations given what is happening around the world, and also with more understanding and awareness of the issues and challenges on the ground of execution as you build more scale and capacity in the country?
Yeah, thanks, Sandy. And I'm referring to my own situation, which is we are owned by a fund which is a global fund, so it doesn't have any mandate to invest in India. So first thing is, there's no love for any country or any specific geography, right? Every project which goes for capital has to stand on its own feet. So they would evaluate the risk and return profile and then say if I have adequate return to the risk profile which I'm comfortable with. That's the basic for any investment. India is not for weak-hearted, if I could say, right? And that way is the investor we've got. Macquarie has been in India for a couple of decades. So they know what India is. So for an international investor, having more experience in India gives them the appetite to maneuver the challenges or situations which come along. So, of course, ignorance is bliss, so there are always new investors coming in and try to dip their toes. But an experienced investor at least knows the situations which may emerge, but that also has a downside that they understand, and maybe, again, it's my personal view and maybe shared by others, we cannot reduce the risk in this country. There have been multiple instruments. SECI was the first experiment and a very successful experiment where the credit risk on discoms was mitigated to a large extent. And there was a lot of investment which came in over a decade. But now we also know that SECI and the other REIs, they might announce bids, but there's no certainty that the projects would come in a particular timeline, right? So you might have a celebration party on getting an allocation in a reverse auction, but the financial close may take anywhere from 12 to whatever months. So the risk situation is very well understood by global investors. I would say that the only way we can win their hearts and their money is to give adequate returns. I've seen a lot of colleagues talking about, we were able to fund solar projects at 12% INR returns or maybe 8% dollar returns. If an international investor is getting 5 or more on a US Treasury bond, why would they take project risk, country risk, emerging market risk, everything, and just do on a 3% or 5% margin over that, right? So what we've realized over the last few years, SK said there's a lot of money available. Yes, there is a lot of money available, but at what cost, right? And that cost is not at all in single-digit US. It has to go touch in teens, depends on the investor's appetite and profile and what level of teens. But we have to align ourselves that there has to be enough returns on the table, then only you can get capital. Of course, there would be exceptions, there would be already committed capital to a particular strategy, and you may deploy for some point in time, but when you go for the next round, you have to convince the investor that there is enough returns available. Risks are going up in the market. Execution is not getting easy at all. We all will keep on talking about land, and it will not get easier because any project you take, any state, Karnataka, Tumkur region, Gadak, Koppal region, there are at least 10 of us, at least, who are vying for the same project and the same locations, right? And that is competition. And that risk will remain. We can't say that, oh, Sandy, don't go to this area because this is my area. I mean, this is also against the anti-corruption, anti-competition rules. So my point is that the risks are going up, and we'll have to innovate on how can we improve the returns available to the investors. To lenders, of course, there's only way to kind of reduce the risk because they can't take more risk. The returns are capped. But for equity investors, at least find ways where returns can be improved. If I had a wish, the only thing which will probably ease in my burden in the investment committees is that if there were relatively lesser surprises on the regulatory side, if we just didn't get a new surprise every quarter, my life would have been easier. But unfortunately, we are in India, and I'm not expecting that to happen.
On that very positive note, I'll turn to Shyam. But that's a really that's painting a true picture. Let's face it. I mean, there is a reason wherein the return expectations are higher than a fixed deposit bank return, right? Because you have to deliver on the ground, and and thanks to that we have all day jobs, because we are delivering more than sitting back and counting the interest cost or the interest bearing FDs that get accrued to our accounts, right? There's work to be done to earn the higher returns. So Shyam, if you had one ask from the government, very quickly, what would it be to help you ease what Pratyush rightly pointed out is attract capital at competitive cost, because there is capital available and in abundance for the right projects.
See, there will be multiple asks. I can't say that there's only one, but at least the top of the priority would be that at least a stable regulatory regime in terms of taxation, in terms of all state regulatory laws and other stuff. And the other major thing is they keep on doing the auctions, but the PPAs are not getting signed. So much of unsigned capacity is there. So that is a major problem at this point of time for all the developers. So how to get the financial closure done and all that. So without PPA, nobody will fund it. The third thing is deepening the capital market and allowing the pension funds and long-term money to come into the market to allow under construction projects and refinancing of operational asset. I think these are the top three in our view. And if some way, what Parag initially told in his morning presentation, one window kind of approval framework is there for all states. So at least we don't have to struggle for so many other things. And allotting more of government land to the developers will help a long way.
Thank you. Lastly, Priyank, very quickly, if there could be one intervention from the Government of India or the RBI that you think would help us get financing at competitive pricing and as low cost as possible.
So Sandy, if I were to say just one thing, I think the key piece that comes to my mind is that, financing and at a competitive rate is very important for any successful project. And I think I don't know if everybody is aware of it, but anything that is lent by any Indian or foreign bank in India, 40% of that amount being lent has to be deployed in priority sector assets, which obviously balloons up the cost of lending to any project. So if the regulator were to consider lending to a renewable project as a part of priority sector lending, that will significantly bring increased amount of availability of capital and also significantly improve the competitiveness or the rate at which any financial institution will be able to lend. So that's the key one from my side.
That's been on our wish list for every budget for the past decade, I guess, but let's see. With that, we've come to the end of the session. In conclusion, all I can say is that net, we've made, as I said at the beginning, significant strides in building renewable energy in the country. But as we look at the ambitious targets that we have to achieve, given that the timelines are short, the runway is very short, we need to see a step up change in terms of development, execution and financing. And as we discussed in the various sessions, while the ecosystem seems to be in place with all stakeholders speaking the same language, we need to address some of these key issues that we talked about through the sessions, in the various sessions through the day and in the financing session, to do whatever it takes to address those questions, address those issues, so that we can continue to attract capital at competitive rates. That being said, if you look at the energy landscape over the last 10-15 years, it's changed considerably and in favor of renewable energy. And this is testament to the realization of a clean energy future that we are all aspiring for. And it's only a matter of time until that goal is achieved. And I think Karnataka as a state in that context will continue to be a leader in the growth towards renewable energy. So that's a takeaway that we have.
There's been a 15-minute overrun. Considering there are people who need to catch flights, do you want to do a question answer?
Unless maybe just couple, if there is.
We can take 2 questions because there are people in this room here who will have to catch flights. Quick ones, please. Gaurav, do we have a micro? Anybody, any question? Put your hands up.
I think the question in everyone's mind is lunch late?
All of the panelists have kind of answered all the questions.
Maybe I'll preempt a question and answer. Lunch is ready, right?
Lunch. So be flexible, adapt to changing needs and changing times. Clearly the call of the day. An excellent discussion on financing structures, both conventional and innovative. Thank you, panelists. I request Sandy to present our panelists with a token of gratitude for your valuable time. One group photo. Thank you. With this, we come to the end of the first edition of the Karnataka Wind Conference. We hope to be back here next year again. Thank you, all of you, for your wonderful, your valuable time and participation and insights this morning. Calling on stage Purnendu sir, Secretary of WIPA, for his vote of thanks.
Active participation and encouraging meaningful discussion. I know most of you have traveled from outside and taken the pain of attending this, but it's going to be very, very helpful for all of us. Thanks to Gaurav Gupta sir, ACS Energy, and Sneha Lokhande sir, you sat MD PCKL, and you sat through all the sessions, you heard all our deliberations. KP Rudrapaiya sir, MD Cradle, he has been the source of inspiration for doing all the RE initiatives for developers like us. And thanks to all the panelists, Anup, Balaji, Monica, Vishal, Vinod, Mr. Raja, then Priyank, Shyam, Pratyush, everyone, Mr. Rosenberg. So everyone contributed to this discussion. And last but not the least, all our WIPA team, which worked relentlessly to make this happen, Raghav, Rishabh, Deepa, Priyanka, everyone worked really hard to make this happen. And I would like to end this whole thing with a quote from Barack Obama. He said that we are the first generation to feel the effect of climate change, but we are the last generation who can do something about it. So now it's the time for all of us to contribute to this climate change initiatives, right? Thank you all. We invite all of you for lunch. Okay.